We know that during COVID, people sat at home and they didn't do much, and Netflix is what they did. This is almost synonymous with streaming for me. This has been a volatile stock for the past 18 months. Netflix is our stock for today. Let's go through and see what we want to pay for Netflix, but also let's see what the bull and bear cases are on here. This has been a volatile stock for the past 18 months. My biggest thing is when I clue into this is when Bill Ackman bought a ton of this and then dumped a ton of it after it had that big 20, 30, 40% down day, whatever it was. So let's get into Netflix right now. Massive streaming service. This to me is a company like Kleenex, like Styrofoam, like Google, where you say, hey, I need to blow my nose, I need a Kleenex. Well, you're using tissue paper, but Kleenex is the brand name. I need a Styrofoam cup. Well, you're using the brand Styrofoam. That's like Netflix. See what's on Netflix, but you're actually going and turning on maybe Amazon or maybe Hulu or something like that. This is almost synonymous with streaming for me. So let's see what we have here. This thing was at an all-time high. Guys, this thing hit an all-time high of $700.99 on the 17th of November 2021. Look at this peak. And now we're at a mere $325 a share, hit a low of 162. It has gone through some crazy rides lately, but you know what? I think that Netflix could be okay in the long run. It's a fantastic company, great content, and it's the place that everybody goes. So right now, let's look at some quick metrics, then we'll dive into the 8 pillars. So market cap, $145 billion. Now when you look at the enterprise value, it's $167 billion. The difference between the two is your debt, of course, and it's not that bad. I was expecting a little bit worse. It's really not that bad. Now they don't pay a dividend. Something that always concerns me here is the free cash flow on Netflix and how they calculate it. This is something that you can go into the 10K and see how they amortize different content that they put out, because they do amortize their content over a period of time. It's a little bit of, not trickery, but it's different about how they do it, and that can make the cash flow look a little bit different. Now, their gross profit margin's about 40%, 39.4%. Bottom line, 14.2. Pretty good for this business. PE, I'm actually surprised about. I thought this was going to be a lot higher. So 32 is not screaming bad for me. But before I go and look at the 8 pillars, I do want to come to the income statement. And the reason I want to do that is I want to check out the revenue. We know that during COVID, people sat at home and they didn't do much. And Netflix is what they did. So when you're looking at the revenue, you're saying, okay, in 2018, they did about $16 billion. Then they did $20 billion, then they did 25. $4 to $5 billion jumps, another $4 to $5 billion jump, and another one. So actually less. But what this is telling me, I don't have to normalize this revenue for COVID. I didn't go from 15 billion here to 60 billion. That would say, okay, that's probably not sustainable. We need to trim that back. Let's look at profit before we jump forward. So net income, the net income has really skyrocketed the last couple of years, coming from 1.2 billion to 1.9 billion, 2.75, and then 5, and about 4.5. So those numbers are rather large. Are they going to be able to sustain that? That's the question. Coming to the 8 pillars now. You see here on this screen how I have the EM 8 pillars, and then I have my 8 pillars. I created these 8 pillars. I went up to tools, and you can do this too, and you can go to pillar screener. This gives you quadrillions of different customizations that you can do, literally quadrillions. You can go in there and change all different things. You can see we're missing on a couple of things here. The 5-year PE ratio on Netflix, 46.73. Mine, I wanted it less than 25. REM 8 pillar, under 22.5, it's not there. ROIC, it hit on the EM 8 pillars. It is an ROIC greater than 9. That's the money that they invest in themselves, what the return is. But for me, I'm a little bit more stringent. I want 12%. They didn't hit that level. Shares outstanding didn't hit on either one. Free cash flow growth. They have it. They have free cash flow growth. I just want to see companies with free cash flow growth hits on both categories. So that gives you a little bit of customization. And the great thing is, if you guys wanted to change these, you can change them to anything you want. Let me show you. You can come here, click this, and it gives you a drop down. You can go through so many different metrics. And if you want to try this software, customize it to whatever you want, $7 for 7 days right now. You can come in here and change 10-year PE ratios, 10-year ROICs. If you want a dividend, you could throw a dividend in there. If you want a dividend greater than 2%, have at it. If you want a dividend greater than 5%, throw that in there and that'll narrow things out. So There's tons of customization that you can do here. $7 for 7 days, sign up for it. So let's go and see what the analysts are saying about this company. And from the analysts, I'm also going to want to look at bull and bear cases. So the analysts are looking at this and saying, hey, we're going to have some pretty substantial growth on the earnings side. This is going from $10.75 to basically $25.25. I mean, you're looking at almost 20% growth here. On the revenue side, you're looking at low teen growth. I mean, that is pretty big for a company that is as developed and solid as Netflix. Now the question becomes, for me, when I look at bear cases, what is going to happen with this password sharing? They are cracking down on sharing password, and they've already been doing it in other countries, and now they're starting to do it in the United States. They're doing it by IP address. So if you share your password with your sister who lives in a different state, well, they might say, hey, wait a second here. You guys can't share this. You're going to have to pay maybe $2, $3 more, and you're going to have to go with that, and now you're going to have a little bit higher payment. Are people going to sustain? They're not overseas right now. They are seeing, and especially in Latin America, they're seeing people drop off and not sign back up. But is that temporary? This has only been going on for a short amount of time. So right now, there's 100 million people that are sharing password. That's what they suspect. That's a very, very, very big number. Now, bull cases. Well, the password sharing is going to generate more revenue. Here's what I think is going to happen. If I was sharing a password with somebody, say somebody was sharing a password with me, I'm going to say, no, I'm not going to have Netflix. And then when a new show comes out, because they wrap you right into those new shows, I say, you know what, I'm going to sign back up for it. So what I could see is that they go like this and they hit a little valley and then they come back up to this peak. That's kind of what I'm thinking will be the situation, but who knows? The other interesting space is this ad tier. So now a lot of these different companies, Hulu, Amazon, maybe not Amazon, Disney, they're coming out and they're doing these ad-based tiers. So now Netflix is going to start doing that. That's just more revenue that they're going to be driving. They're giving you, it's either 2 to 4 minutes of commercials per hour of watch time. So that right there, cheaper price, gets people in the door, and then gets ad revenue from, they can monetize that side too, which is an awesome thing. So Netflix to me is very interesting. The only thing that really worries me about them is the cash flow. I don't know how to understand their cash flow. So let's see what we can do in Stock Analyzer tool. So on the revenue side, let's say that they hit 5% for the next 10 years on the low end. We'll go 5, 8, and 11. Let's say they absolutely crush it on the high end in revenue, and that is the best case scenario. Profit margin. Now, it's been big the last couple of years. You can see that right here. The 1 year number is 14. That 14 is incorporated in this 10-year number. They've absolutely crushed it the last 2 years. So you know what? I'm going to come in here and I'm going to put in 7, 9, and 11. Free cash flow margin. Like I told you guys, the free cash flow is difficult, but I'm going to put in 7, 9, and 11 because those should equal out over a long period of time, especially if they give them another 10 years. I'm going to go with 15, 17. You know what? I'll go 15, 16, and 17 because I think that 19 would be too high of a PE to give them. It's not like they have a great return on invested capital. So let's see what this comes out to. So the current price is $324. Oof. I thought this would be the case, and it does make sense. If you look at the PE of 32, this makes sense. $84 on the low end, $167 on the high end, a middle ground of call it $125. That's probably where I would start looking. But even before I did something like that, I need to understand the cash flow. Go understand it in the 10K, $7 for 7 days. You guys have a great day.